Audited financial statements are preferred, but if part of the loan package, they'll accept reviewed, compiled, or even internal financial statements, especially in this economic environment. I mean, the banks have lots of cash. They want to make loans. They want to make sure, and they just want to get comfortable that they're going to get repaid at the end of the day. Some banks have bright lines of when audited financial statements are required. It's usually based on the commitment amount or the loan amount. You get over $3-4 million expected, a requirement for audited financial statements. If you have a great balance sheet, they may be able to go down to a reviewed financial statement, but there's going to be some sort of financial statement requirement, probably in those loan documents at those sorts of lending dollars, unless you have just a great history and a lot of liquidity. If you had a bump in the road, if you had a loss 3 years ago, 2 years ago, be ready to explain that to the bank. Tell them what happened. Tell them what you've done. Tell them how you corrected it. Tell them what you're going to do going forward so that doesn't recur. They're going to ask for personal financial statements of owners and typically 3 years worth of tax returns to match up to those personal financial statements. Be prepared to do 3 years of budgets and projections. We typically, when we help our clients do that, we do the first year monthly. Banks want to understand if there's any seasonality to your business. And we have seen banks adjust payment terms on loans based on those cash flows. I mean, we have people in here that do that. They have a high seasonality in their business. They got, probably 80% of their revenue comes between March and September. So they pay back their loan between March and September, and it's interest only between September and March. So that works out very well for our clients, and it also works out very well for the bank. They want to make sure they don't have to watch how much cash reserves when you have going into those slow periods. It makes them more comfortable that you're going to be able to make it through that slow period between September and March before your cash flow picks up again. Bios of key management and listing of other advisors, becoming more and more important. I mean, client wants, the banks want to understand who else you're dealing with. Do you have good advisors surrounding you? That's important because they want to make sure if you get in trouble, you have good advisors that can help you get out of it. Prior to remitting the loan package, or prior to even, don't just send a loan package to the bank and ask them for a proposal. Try to get a meeting with the bank, and not just the relationship manager. Ask them to bring out their team of who would service your account. Understand, who's part of that team, what are they going to do, what each of their roles are going to be in the relationship if you decide to switch your banking relationship. Explain any problems that you've encountered and how you corrected them. So when you give them those 3 years of financial statements and you had a loss 2 years ago, it's not going to be a surprise to them when you give them your financial statement. And make sure they understand what you've done to correct that situation. Explain any unique issues that you see in the next few years. Owner buyouts, capital needs, loss of major customers, how you deal with the loss of a major customer, or if you're looking at acquisitions, how's that going to play into the banking relationship. Explain what you're requesting in terms of borrowing and service needs, especially if you have any unique needs, international currency, swap, letters of credit, those sorts of things. Again, the more the bank understands, ask for their input. If there's anything, here's what you think you need, but are there better ways to go about it? Maybe the bank will recommend an IDA loan, an SBA loan, something like that to make it easier on you, and ask them why they believe it, and make sure you understand why they're proposing one versus another. Follow up after the meeting. Again, this is all about establishing a relationship with your banker. Send a thank you letter, even better, call them after the meeting, ask if they have any follow-up questions. typically what's going to happen is, they're going to bring out a group of people, 3, 4 people, and they're going to all get in the car and they're going to ride home and ride back to their facility, and they're going to start to have additional questions that they say, oh, we should have asked this or we should have asked that. Call them, ask them if they have any other questions after the meeting. Follow up timely. Remit the requested information timely. If they ask for anything, give it to them kindly. This is your first test. Get off to a great start, even with a potential bank. If they ask for information and you've committed to give it to them a day or two earlier than what you committed to. Verify that they received all the requested information. Request a copy of the proposal before you sit down and review the proposal with the bank. That way, if you're getting 3, 4 proposals, you can sit down and have a good comparison between all of the banks before you sit down and meet with them to go through it. Get a copy to your other advisors, get their comments. So when you sit down for that final meeting, you have all your questions together and understand what you need to ask them to get a better understanding of what you want to do. I mean, if you sit and have initial discussions with 3, 4 banks, at most I would think you'd have final discussions with 2 to at most 3 banks. I would think you would narrow down for the final meeting.